The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good Friday morning, Long Island. This is Money in the Morning with Mitch Goldberg, where we dive into personal finance and market-related conversations to keep you up to date and on the right track so that while you are working hard for your money is working hard for you. My name is Bobby Bird, Mitch's partner. I'm your host today, filling in for Mitch, who is on assignment this morning. Start this morning with a brief update on the market. Futures this morning are indicating another down open, with the S&P futures off about 32 points or 0.75%. NASDAQ futures off about 125 points or less than 1%. And the often watched Dow Jones Industrial Average is indicated down 193 points or about half of 1%. West Texas Intermediate crude oil is trading down about $2.39 a barrel, or almost 3% this morning. And the popular 10-year Treasury yield is stair-stepping higher yet again, now at 3.89%. Yesterday, we saw the major indices swoon as inflation fears again were at the forefront of the market. The Dow dropped over 431 points, S&P fell 57 points, and the NASDAQ dropped 214 points, all over 1% each. The big news yesterday economically was that the Producer Price Index, otherwise known as the PPI, which is a measure of inflation at the wholesale level, increased 0.7%, which was higher than the 0.4% expected. And the prior month was actually down 0.2%. So PPI is usually a precursor to future CPI, Consumer Price Index. Because when manufacturers pay higher prices, what do they generally do? Well, they pass them down to us, the end consumer, which is evidenced by the CPI. Earlier this week, we saw January CPI report in line with expectations. Why? Well, because prior PPI was down, negative. So we have this tug of war playing itself out between gyrating inflation data and a Fed that said that it's going to continue to be data dependent with respect to future rate hikes. And when the data is moving this much, it's very difficult to find a trend, not just for us, but also for the Fed. At the last Fed meeting, the FOMC, the Federal Open Market Committee, they voted to raise rates by 0.25 basis point. So they're due to meet again March 21st, 22nd, which will include an often talked about summary of economic projections, which hopefully will provide more insight to their intentions for the trajectory of Fed fund rates. So basically, the moral of the story here is to stick to your investment discipline. Don't become overly optimistic or complacent, in my opinion, for the next couple of months, and keep some dry powder on hand. Okay, so I'm going to pivot now to something I wanted to talk about today on Friday. I always tell people who ask me what we do for a living that I'm in the relationship business. And after they look at me a little perplexed, when I further explain that I'm a financial consultant, I stress that you could be the smartest person in the room, but without first being able to build a relationship and creating a connection and trust with someone, none of that matters. So this morning, I want to talk about some common issues investors have with financial planners. When we meet with prospective clients who are currently working with a financial planner or advisor, and they ultimately become clients of Client First Strategy, it's usually because of one thing. They're unhappy with the service they're currently getting from their advisor. We rarely gain a client because they were unhappy with investment performance. Instead, they often tell us that they're looking for something different. They want someone who pays attention to them. They want someone who listens. They want someone who doesn't judge, who doesn't speak over their heads with unnecessary jargon. And most importantly, they are looking for answers to their individual questions. So we have found that there's an overwhelming theme and consistency within their unhappiness, and it's important to listen and learn from these concerns. So the first one that comes to mind is that one's financial advisor has a conflict of interest with their investment advice. Unfortunately, we hear it all the time, whether it's an investment annuity, whether it's a life insurance product or a mutual fund. It's important for clients to know that the recommendation that they are receiving is in their best interest. Many clients sadly find out that after a transaction's been completed about the healthy commission check that the planner or advisor received for offering their advice. Shouldn't be. There should be complete and utter transparency from the beginning. The job of a financial planner is to help individuals and families make important decisions that greatly impact their retirement goals, their philanthropy initiatives, or even generational giving. We believe that these decisions must only be made with the best interest of the client in mind. You've heard a lot about the benefits of working with a registered investment advisor, such as myself and Mitch, and the importance of fiduciary responsibility. In an RIA structure, there's no middleman between us and the client. There's no firm to push product. There's no lavish trip incentives to squeeze additional revenue from advisors. When you do what's best for the client, the money often follows. The second item that comes to mind is a financial planner who is set in their ways and doesn't think outside the box. Many planning firms use planning software, ours included, which can be time efficient and scalable throughout our client base. A large drawback that we have found, though, is that some financial planners just use the numbers as data inputs and don't think through the recommendations that the software is actually producing. By thinking about the client's situation outside of the box, we're able to come up with more creative, personalized solutions that work better for our clients. As an example, we oftentimes have clients who come to us asking for advice on the timing for collecting Social Security, right? So, you could take all the numbers and put them in a software, and 10 times out of 10, it will tell you if you defer collecting Social Security until you're 70, you're going to get more money. But when you think outside the box and take a look at a client's personal financial situation, if they need to spend down assets to be able to wait to defer to collecting until 70, well, that makes no sense. So, case in point, right? Taking a look at a client's personal financial situation and using kind of the numbers as a guide rather than just using the numbers as gospel helps us as planners put your personal situation in the forefront. A third item, right, is lack of continued education. So it's very important in our field that a financial planner stays on top of the ever-changing landscape. A financial planner 20 years ago is much different than a financial planner today. Clients need to have confidence that their advisor and their team of support advisors is up to date on current technology, investment solutions, tax laws, and estate planning opportunities. Requiring an advisor to be a CFP, as myself, or certified financial planner, is a great way to demand continued education because a CFP is required to complete educational credits every 2 years. So in the same way that you want your estate attorney to be on top of changing estate tax laws, or you want a doctor to be, on top of changing issues in the medical field, you should demand of your investment advisor to also be on top of the financial changes with respect to tax laws, with respect to estate tax laws, as well as the investment landscape, to give you the best advice possible. So on the other side of this break, we're going to continue with a few more items. I hope you all are enjoying this episode. This is Money in the Morning with Mitch Goldberg on 103.9 FM, Long Island News Radio. And we're back this morning on 103.9 FM, Long Island News Radio. I'm your host this morning, in place of Mitch, Bobby Bird. This is Money in the Morning. So getting back to what I was talking about earlier before, when we were talking about, about the market update and keeping dry powder. What do I mean by that? So when we advise clients and we're going through, discussing proper asset allocation and having a discipline, having an investment discipline. Whenever you have uncertainty to the market, as we certainly still continue to do, keeping dry powder just means, keeping cash on hand with that you may otherwise have invested in the market, but just keeping it on the sidelines. Because last year we had a number of instances where we had, these bear market rallies where the market would bottom and then we'd have, a voracious jump up in the market only to come back down again. So, we're still in the camp of we've got, we're starting to make progress with respect to positive earnings coming from companies. We have, employment growth is still pretty healthy. But really it's the Fed that's the unknown here. And I think the Fed is just as perplexed as everyone else, because being as data dependent as they are, when the data is gyrating as much as it is, it's very difficult to get a handle on, should we continue to raise rates? Is there a lag effect to the rates that they've already increased? And increasing rates too much may, just stumble the economy. And that's what the Fed's trying not to do. And they are walking a very, thin line here. So it's quite hard and difficult, to put a pin on, are we kind of out of the woods yet? And that's why we say keeping dry powder is pretty crucial here. We still continue to see attractive rates on the short end of the curve, for, our clients to put idle cash to work, in T-bills, as well as money market fund, just to allow this market to really, kind of play itself out. But I wouldn't be too complacent. I also wouldn't be too much of a doomsdayer here as well, because things often change over the course of a day. So as we're speaking now this morning, the futures are off of their lows that they were kind of earlier this morning. So, keeping dry powder, keeping a discipline, keeping a strategy in place, and being in constant communication with your advisor with respect to your goals and objectives for, each pool of money is crucial here at this stage of the game. So getting back to some of the other items that we were talking about, right, which were some common issues that we have found investors have with their financial advisor when they come and speak to us for consultations. Number 4 is lack of time to communicate and discuss problems as they come up. What's the key to a healthy relationship? Whether it's a marriage, whether it's a business partnership, whether it's a friendship, whether it's a client and advisor. The key is constant and transparent communication. So in our industry, right, a simple annual plan review, a phone call, or even, a meeting is often not enough. Clients demand that their financial planners be available throughout the course of a year. As your situation changes and evolves, we want to know about it. And it's kind of our job to be more proactive in determining that. So a client relationship, in our view, is not a set it and forget it relationship, and continuous dialogue is a must for a successful relationship. So this includes daily monitoring of client accounts through technology to make sure that your portfolio remains in line with your objectives. We've had several clients join Client First Strategy because their prior planner or advisor just did not continue to monitor or review their portfolio once it was established. So what can go wrong? Well, you could have cash start to build up as stocks pay dividends, as bonds pay interest. And unless that cash is redeployed and put to work back into the portfolio, we've had clients come to us with 10% or more of their money in cash when it wasn't their intent or their objective. The other item is that there's no proactive management of the portfolio. When the advisors charge a fee to manage a portfolio and there's no activity, that's known as reverse churn. You want there to be, proactive advice and management of a portfolio as things change in the market. You don't want a portfolio to just sit there because you could have over concentration in certain aspects of the market, or you could have under exposure to sectors or asset classes that are outperforming. So that's quite important and crucial. The other item that we see is that, certain advisors maybe aren't comfortable bringing in outside experts. A client should expect that their advisor be current in investment strategies, tax issues, and estate planning opportunities. So in many cases, it's in the best interest of the client and planner to bring in an outside expert on a specific issue, whether it's in-house or a third party. What do I mean by that? Well, CPAs and estate and elder care attorneys are crucial here, right? So we've had great success holding advisor summits, we call them, for clients that are going through important life decisions, such as selling a company or making big estate planning decisions. We have 2025 coming down the pike, where tax laws are going to revert back to what they were before the 2017 Tax Cuts and Jobs Act was put into place. So it gives, clients with high net worth an opportunity to make gifts or, take advantage of strategies to reduce their taxable estate that once 2025 comes around, they've lost that opportunity. So we quarterback these meetings, as I said, that include a CPA and estate planning attorney. It's amazing how much you can get done when you have all these experts in the same room, rolling up their sleeves, sharing ideas, and working collaboratively to achieve the best results for their client. It should be a collaborative effort, right? I love taking a collaborative effort, as does Mitch, with our clients, right? we don't want to have a monologue. We want to have a dialogue with our clients day in and day out. And that's crucial. That's crucial to the success, to the long-term success of a relationship, right? So being able to find the right planner or advisor is an important decision for a family. And there's no reason for you to accept anything less than a team that demands excellence of themselves. And that's what you'll find with Mitch and myself and Client First Strategy. To learn more about us, you can visit our website, clientfirststrategy.com. That's clientfirststrategy.com. It's been great having you. It's been great being here along with you. Thank you for your time. We hope everyone has a great holiday weekend, and we look forward to seeing you soon. All the best. Take care now.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.